My name is Michelle McLaren and I welcome you to the ABCs of Health Insurance. I'm a licensed health insurance broker in the state of Texas with my own agency, Just the Facts Insurance Agency, and I'm also a licensed health insurance counselor. I'm here to explain the confusion that is health insurance, especially for individuals. Insurance is evil. Let's turn evil into easy with answers. Today's letter is D. D is for deductible. Deductible is an amount of money that you have to pay towards your medical goods and services before the insurance starts to pay. There are some items that may be outside your deductible, meaning that you can have that insurance benefit before you've paid your deductible. Copays, which are a fixed amount for a product or service, are usually outside the deductible, and on Affordable Care Act qualified plans, your annual preventative exams are covered at no charge outside the deductible. After you pay your deductible, you then often pay a percentage of your remaining costs, which is called coinsurance. This is defined in another video, C for coinsurance. Before the ACA went into place, average individual deductibles were usually around $1,500 to $2,500. Now they're more likely to be $2,500 to $6,000 a year. Insurance has increased the deductibles overall in order to have lower premiums to present to consumers. The amount of the deductible directly ties to your monthly premium. Lower deductibles equal higher premiums, and the converse is true. You want that, you're willing to take the high deductible risk, they'll give you a lower premium for it. Many people think that a lower deductible is always better and worth the extra monthly premium, but this is not always the case. It's more important to look at your maximum out-of-pocket charge. Everything you pay except your premium on an ACA qualified plan goes towards your max out-of-pocket. This is your deductible, your co-pays, and your coinsurance. This is new since the ACA took effect. It used to be that your deductible was separate from your max out-of-pocket. So if you have a lower deductible on a plan and you still have a really high max out-of-pocket, when the bad thing happens, you're still going to be out a larger amount of money, so why be paying the high premiums the whole time for the lower deductible? Most of the time, people will find that they can save thousands of dollars over the course of a year picking that higher deductible, lower premium plan. If you can get a lower max out of pocket for your higher premium, that may be worth your while. The biggest exemption I've seen to this rule is for someone who has an expensive medication that might not be covered until they've met their deductible. Sometimes that can work out over the course of a year to go ahead and pay for a lower deductible plan to get that medication covered in full more quickly. The most important thing overall, as always, is to look at your expected annual expenses and figure out what's best for you. How much it costs you per month is not what you need to look at. If you can't afford it when a bad thing happens because you took a cheap premium, doesn't help. If you're paying a fortune in premiums and then no bad thing happens, you might not help yourself either. So it's important to evaluate the whole year. What is your general needs? What happens in an emergency? And figure out what's best for you. Thank you for taking the time to listen to me today, and I hope you found this information helpful. Check out my other videos or leave your questions in the comments. Education is important. That is why I created Just the Facts Insurance Agency, so you can have just the facts you need to protect those you love. Peace and health to you all.